Let's get started. Just a quick look at the agenda here. And I did want to note that this will be the second to last Market Matters, official Market Matters monthly update that we'll do. Certainly something that we started back in 2024, or I'm sorry, 2020 during COVID to help bring you all up to speed on what we're doing in the portfolios. I think has really been a beneficial value add in a lot of ways. But certainly we're getting long in the tooth in the bull market. We want to refresh the format and the way we deliver content to everybody. And now, as part of a large organization, the Colony Group, we do actually have some really talented uh, portfolio strategists on staff that do things very similar to this. So we'll do one final one, but starting in January, we'll be looking to transition those activities over to the global strategist, Jason Blackwell from the Colony Group. But with that little programming note out of the way, here's a quick look at our agenda. And similar to prior periods, we're going to touch on some macro ideas, some portfolio themes here for the remainder of 24. We have made some adjustments to the asset class ratings, so that's kind of reflected and updates the portfolio we made more recently. And then a look at these three broader categories of stocks, bonds, and alternatives. In each of those categories, there are some unique things driving performance at the moment. So we'll talk about those. So just a quick look at the health of the U.S. economy. This is our two ways to look at that through a services lens, which is the purple line, and the manufacturing lens, which is the orange line. And recall just again, the numbers above 50 indicate expansion, numbers below 50 indicate contraction. And in similar picture, services more recently have been pretty stable around the modest expansion, but have more recently in the most recent update that was published, I think it was actually today, saw a reacceleration of the services sector. Manufacturing continues to be a bit of an anchor here to some degree, but again, it's much smaller component of the economy. And in that way, it's less relevant to what's really pushing job growth and creation higher more recently, which we'll see here in just a moment. But for the time being, we're going to hit on this as a collective theme is that this slow and steady growth is really a nice set of conditions for markets to perform in. It's kind of that Goldilocks scenario that not too hot, not too cold, which should also help and influence inflation coming lower over time. So here's another maybe newer look at the jobs market that we've more recently been in connection with some of the publications from the Colony Group. But this is a picture of the job market. So the number of job openings here over time on a monthly basis, going back to 2000 in the blue line, and the orange line is the unemployment rate. You can see again, certainly more recently, there has been a lot of consternation about the reacceleration higher and the unemployment rate. But what I always go back to is saying unemployment rate coming off of the all-time low level isn't necessarily a bad thing, and this reacceleration higher should accompany expansions as they get a little bit longer in the tooth. And certainly, while number of job openings is coming down, that's very a positive sign for the job market. Neither of these two things would indicate we're anywhere close to some sort of catastrophe or calamity, because we've got, again, kind of an equilibrium level being reached here where unemployment rate is rising to that kind of normalish level of between, call it 4.5%, 4 and 5%. Job openings are coming down, which would indicate a little bit of a cooling in the economy, but nothing too dire, as the title suggests. The last piece I just wanted to touch on here is U.S. dollar and kind of the dynamics. And after a pretty sizable move higher, it's really been in this very steady sideways trading pattern, which is a bit unusual, particularly given that yields more recently have really shot up from a low level of, call it 3.65% all the way up to now where we are at 4.3 on the 10-year. And that should lead to some differentials on the currency side, but it's actually been pretty stable around these levels. And that's kind of what you want to see is a rising dollar is certainly not bad if you're a U.S. citizen, but it is tricky if you're an international economy or citizen. because it means your debt service, if it's in dollars, becomes more difficult to service. And with a stable currency that's not moving around too much, that tends to be, again, good conditions for financial assets that we still think has some runway left to it. Now, if this were to go meaningfully higher, and we'll see, after Election Day, if we actually do get a result here within the next 24 hours, which way the market perceives the current president being dollar positive or dollar negative. That would be interesting to observe. And, I think what we would be looking for would just be very sharp moves in the dollar, which I don't really anticipate seeing that anytime soon. Now, one factor we do have to keep an eye on some later this week is the Federal Reserve is meeting for their Monetary Policy Committee, in which meeting they'll make a decision on additional interest rate reductions or interest rate cuts to the federal funds rate. And by all accounts, given that inflation is moderated, job growth is coming down with unemployment rising, most market forecasters think the Fed will cut again here in November and then again potentially in December. We'll have to obviously see how that happens, but probability wise, I think the market's pricing in a 99% probability that the Fed will cut rates 25 basis points here in November. And I think a 65 or 70% chance that it'll cut rates in December. So again, that's a positive condition for stocks to perform in. And just as a quick reminder, no matter who wins, and the presidential election sometime later, hopefully later tonight, or maybe sometime the next day or two, neither candidate is very deficit friendly, and extending tax cuts as you can see kind of the build out of what each administration is potentially going to do to the federal debt and deficit. And again, it's either 1.2 trillion according to CBOE estimates or 5.8 trillion deficit increase under President Trump. So these are big numbers. They're becoming increasingly more concerning to us as maybe they have investment implications. We've talked a little bit about some of those implications, but it certainly is re-energizing our efforts relating to what we call monetary hedges. And that would be things like gold, precious metals, or Bitcoin that have, more stable purchasing power properties to them relative to a central bank currency that can be adjusted over time. So here's some big picture themes. I just wanted to highlight on what I think we started to talk about last quarter or last month, but I think I've just framed it out here more simply this time around. And I know there's, a lot of election hand wringing and things of that nature, but I think regardless of who gets in office, the cruise ship does not turn very quickly. And precisely because we have three factors working in our favor, I think markets will likely migrate higher over the balance of the year. One is that the economy is still fairly good. I just showed you, the services sector continues to expand. That's leading to annualized growth in the U.S. economy in real terms, meaning after inflation of between 2.5% and 3%. That's a really positive foundation to build off of. Additionally, you've got, as we'll talk about later, good earnings growth in the S&P. Earnings are actually coming in surprising to the upside, which is a very positive development. One reason why stocks are up yet again today. And then you've also got this situation where it's not just the Federal Reserve, but it's most global central banks. So whether that be the Bank of England, the Bank of Japan, and other major global central banks are all cutting rates in unison. So this provides a really sizable or a beneficial backdrop around which stocks generally like because you've got not a lot of wild cards that could throw you off. Speaking of wild cards, though, as we mentioned, I still think there is concern, in my opinion, of when are these hot wars going to ebb? Likely no time soon, unfortunately. We did get one kind of vol event earlier in the year with the carry trade unwinding in Japan. But we still have simmering hot wars in Ukraine and Israel with various levels of escalation or de-escalation going on. But the point is we run the risk of mistakes being made in those areas. And the longer those go on, the more I think the risk grows that those regions could lead to some contagion. Yeah, as a reminder, politics is not financial markets and no better day to remind people of that than on election day, just because whoever gets in office will not be able to change the direction of the economy very easily. And looking at the future, there are a number of powerful developments, AI, robotics, biotech, all leading to productivity enhancements, which ultimately drive economic growth over the long term. And then, finally, reading the tea leaves, Fed tea leaves is kind of what we're getting after here. After the first rate cut in September, we do think there is a growing risk that, and our bond portfolio certainly reflects this right now, that they are cutting interest rates into a somewhat modestly hot economy. And that does run the risk of market participants losing credibility, or the Fed losing credibility with market participants, and reignition of inflation. There's a chart I was sharing with the team earlier today talking about the experience of the 60s into the middle of the 80s, and kind of how time period right now is reflecting some of that trajectory. We'll share that on the next 2 minutes update on Monday. But nonetheless, there is a lot of rhyming going on with the 70s that we should all hope doesn't rhyme too closely, because after inflation, if you recall, in the early 70s, inflation moved up from, I think it was 3% to 6 or 7, came down, and then had the next leg higher due to the oil embargo that shot inflation up to the low teens, and then came back down in the early 80s. So, we should all hope that that's not going to be a repeat, but we'll just have to wait and see how things evolve. Looking at some of the asset class ratings, as I mentioned, there were a number of adjustments to the portfolio. And these are just modest adjustments, so nothing too broad sweeping. But again, I think just pointing out here, we did have a slight overweight to mid cap, and we did add some in either individual stock portfolios or on the ETF side. That overweight or slight overweight has come down to a more neutral rating. These are, again, very modest adjustments, but again, just kind of helping everyone reflect where we see opportunity and where we don't. Still have a neutral rating here on developed markets, even though they are, less expensive than in US. That's a kind of a common question we get from clients is, aren't international developed markets like Europe a lot more attractive from a valuation standpoint than the US? A lot of nuance to that answer, but the short answer is not necessarily, because of the composition of those economies and countries versus ours. It's still, I think, a superior position with US led companies. Still have no real love for emerging markets, and I think that's kind of playing out again this year, where the S&P is besting the emerging market index, broad emerging market index. Yes, we do acknowledge there are parts of the international emerging market complex, think India or Vietnam or Malaysia, that could present really attractive opportunities. Our thought, though, there is that just is really quite difficult to get right, because the timing from not only a currency but also an entry and exit standpoint remains exceedingly difficult. So we have decided to avoid that until we see a really, really attractive opportunity to get exposure for the first time in 14 years. On the bond side, we did downgrade some of our duration exposure, having increased duration a little bit in Q1, increased duration again in Q3. And now that we've had rates migrate back up to a certain level, we think we're kind of in a sweet spot right now of kind of shorter term duration still within the bond portfolio. We still have a bit of outperformance there across all portfolios, but downgrading both government and municipal bond to more neutral, just as reflective of the fact that we're less excited about duration right now. Certainly, we're not very excited about emerging market junk bonds because the relative yield on those securities is now approaching very low levels, and in which case, why even bother? If you're only getting, a couple of 100 basis points higher of yield than a treasury, is that really reflecting increased or enhanced credit risk? We think the answer to that question is no. So we're going to avoid that. And then as far as like alternatives go, again, I still need to add a column in here for what I call monetary hedges, things like gold and Bitcoin, which we do find attractive right now. But even things like real assets or liquid alternatives, private alternatives are remaining, I think, very attractive in this market because remember, most of those strategies perform pretty well when there is more volatility in the markets. And certainly that's been showing up more recently, not only in the equity market, but also in the bond market. If you use the MOVE index as a proxy for bond volatility, it's at levels approaching where we were just after COVID. Just turning to stocks here, and this is, I think, a simple way to summarize our belief and what's likely to occur in the stock market for the foreseeable future. And that is there are portions of the stock market that are not performing to expectations. But I think more importantly, there are the largest parts of the stock market are outperforming expectations. And that's why you see this levitation higher in the stock market. So if you see this is a year-over-year growth in the S&P earnings at the end of Q3. So on September 30th, this is what the market expected those growth rates to be in earnings. This is actually what it was today, and this is as of October 25th. And you can see in those areas that I highlighted in green are all sectors of the economy that are outperforming the expectations that these are analysts' expectations. And in particular, I just wanted to point out two of the sectors I hear the most concern about, that being financials and real estate. Both are outperforming analyst estimates. And that, I think, speaks to number one, quality of management teams being able to make adjustments to those companies as they see opportunity. But also, number two, these are actually the more two very sensitive sectors of the economy to changes in the growth rate. And I think financials in particular, performing as well as they are, given that they are very sensitive to changes in the US growth rate, are putting behind them maybe not only problems with commercial real estate that people think could be still lingering, but also are showing you they can perform in an environment where they do have a lot of headwinds potentially in front of them. Things like private credit strategies taking loan opportunities away from banks, or fintech companies eroding customer bases. They are finding ways to, and banks in particular, finding ways to generate profit while also surviving in this very tricky environment for both real estate and things like private equity. Of course, industrials, materials, energy are very sensitive and cyclical parts of the economy. You could say those are also very sensitive to changes in the economy. But I think, these are much, much smaller components of the economy, as we talked about in the beginning. Whereas financials, information technology, communication services really dominate the job growth and creation and cash flow of the S&P 500 right now. So we're not as concerned about these because these will always be quite a bit different than the analyst expectations. Just turning to bonds real quick, and then we can certainly leave it open for questions. Just as a reminder, if you do have questions, drop those into the chat function. We'd be happy to address those as they come in. But here's just a quick look at bonds again, maybe from a zoomed out 30,000 foot perspective going all the way back to 1990. And one of the reasons I just wanted to point this out is number one, I totally forgot that 10-year bond yields back in 1990 were over 7.5%. They were close to 8%. Right now we're at 4.25%. And is it really that concerning to be worried about bond yields that go from, let's say, 4% to 4.5% in the context of where we've come from? That's one piece of it. But number two, as I think the chart does show pretty clearly, we do seem to have hit a paradigm shift in the direction for rates. And that's one thing I think you notice if you look at interest rates long term, is that they tend to evolve in cycles. Ray Dalio at Bridgewater talks about this credit cycle, economic cycles, and then kind of there's other types of cycles in his book that he references. But one of the cycles we're currently in is a secular cycle as opposed to a cyclical, where for the better part of 30 years you had downward impulse on interest rates in the US, particularly in that mid-range, which is really important to things like loans or mortgages. troughing at the nadir of COVID back in 2020. And then more recently, you can see that there's just been this grinding impulse higher in yields that I think still probably has a little bit of ways to go before we finally reach the peak of this cycle of where rates are meant to go. Certainly, the Fed could interject themselves and step on the neck of interest rates and keep them where they are temporarily, but that also risks inflationary impulses, which would be pretty tricky to navigate. So we're playing bonds, pretty cautiously at the moment. And then just circling back to REITs, and this is the kind of dovetails into my comments about, you know, maybe the anxiety around financials is a bit misplaced because you can see here, these are four different things. One is the purple line is the Vanguard Real Estate ETF. This is just a market cap weighted index of the largest real estate investment trusts. Now, this is a mixed picture of digital real estate, so things like data centers, storage units, life science centers, but also multifamily units, office space, industrial space. So this is a broad, mixed bag. And then what's performed even better than that, believe it or not, this is a year-to-date picture. This is not adjusted back any further, starting on January 1. These three companies right here, they're SL Green, which is the largest landowner, office owner in Manhattan, New York. Vornado Realty, which is a large office owner across major East Coast gateway cities. And then BXP is another diversified but largely office owner around the United States. All three of these are doing better than the broader REIT index, which is interesting, but also number two, SL Green being up 70, Vornado up 53, BXP up 30. These are all punching above the S&P 500 return for the year as well, which just suggests that a lot of the shareholder base of a lot of these companies potentially is turned over significantly, and that a lot of the anxiety or distress that is being thought about that's in real estate may already be priced in, and that investors are looking past it towards the future. Now, remember, public real estate or public vehicles tend to lead private vehicles by 12 to 18 months. This troughing occurred early middle part of last year. So maybe that's also suggests that private real estate valuations are on the cusp of inflecting upward as opposed to moving significantly lower over the last couple of years. And then just getting to my slide here and the concept of monetary hedges, I think we do have to take some inferences away from what both of these are telling us. And let's just focus on gold just for the moment, because gold is probably much more of a tangible asset class to wrap your head around versus Bitcoin. A lot of people consider Bitcoin to be just a levered version of gold for a variety of reasons. No cash flow, stable no net new issuance, perceived as a store of value. So some of those considerations. In any case, gold being up 31% in a year where the S&P is actually up 24 is really perplexing. And you have to ask yourself, well, why is that? There's a variety of reasons I could point to. We have owned it just as a point of fact. We have owned gold one time before when this was in 2013, 14, when there was a lot of anxiety around the budget situation coming off of the great financial crisis. European financial crisis was still brewing at that time, and we use it as a hedge to our portfolio to address issues that might spin out from those areas, from those situations. Well, here we are again, and gold is up, 30%. I think that this is telling you that a lot of institutional money is actually migrating potentially some of their bond portfolio out of bonds into things like gold or other hedges. It's also reflecting, I think, some of that anxiety that's out there around the long-term debt picture for the U.S. and most other G7 nations. There's also, I think, an aspect of this, and again, these are just my thoughts. They're not necessarily shouldn't be perceived as gospel here, but the other idea so the BRICS conference, this is the Brazil, Russia, India, China emerging market conference, just happened. And I think there's been a push globally to move away as fast as possible from a US dollar centered trade settlement structure. Now that's a big, lofty, ambitious goal. Certainly, we're nowhere close to that, but it is important to note that some global central bank holdings of dollars have been steadily declining over the years to the point I think where it represents something like 58% of reserves now, down from 75% back in the mid 70s. So certainly something to keep an eye on, but I think gold is telling us that there is inflation problems potentially on the horizon, and that some investors are trying to get out in front of that. So let me just summarize some of the thoughts here, and certainly can open up for questions. But a few things. One is that I would just say continue to reflect the idea that market conditions continue to look supportive for stocks, even though we are back near all-time highs. You have a liquidity impulse coming back into the market where global central banks are cutting interest rates across the board. It's not just the US, it's not just Europe, it's Japan, it's the Bank of England, it's the Bank of Canada, it's emerging market central banks. Everyone globally is cutting interest rates, and that by extension is stimulative to financial conditions. We also have supportive growth in the US as well as earnings in the S&P that are beating expectations. So you've got kind of a nice cocktail here for at least returns over the next quarter or two. Again, but now that we're at all-time highs, never a bad time to manage risk, particularly for those that are carrying concentrated positions. We see quite a few of these come across my desk on a quarterly basis, whether it's hedging using option collars or using tax management strategies to deal with concentrated positions. These are all great times to now consider using those because, like I always say, there's never a better time to consider dealing with a concentrated position than at all-time highs. We still have, as I pointed out, a kind of a negative view on bonds to some degree. I wouldn't say, I mean, negative sounds too draconian. Negative on duration, let's say that. There are still opportunities within parts of the bond market, things like structured credit, mortgage bonds, private loans in particular are all examples. Munis can have some opportunity there as well for clients that are in high tax states. But duration, which can be a more attractive diversifier, has less attractive now that we've got rates moving again. And then conditions, I think, are improving for alternative strategies as well. I mean, this is probably going to be a constant bullet point here because as the VIX continues to stay, this is the volatility index, continues to remain above 20. Recall that average level for that historically is somewhere between 15 and 16. With the MOVE index, which is the bond volatility index, now nearing kind of COVID type levels. These are conditions that should be exceptionally attractive for alternative strategies, which, as you all know, we have quite a bit of an exposure through either on the liquid side or the private side. And we think the outlook for most of those strategies looks pretty good. I certainly appreciate your time today. The recording will be available as well as a copy of the slideshow will be available shortly. This will be the second to last Market Matters. We'll do one in December, and then in January, we'll hand it over to the global strategist for the Colony Group to provide these types of updates going forward. Thanks again. We'll talk soon.